In Ghana, the country has raised its key interest rate by 100 basis points to 28%, and that's as authorities ramp up measures to manage the high cost of living. Now, the central bank hopes the rate hike will slow down inflation and also tackle the depreciation of the local CD currency, which of course has lost half of its value last year. CGTN's Nabil Ahmed Rufai tells us more from Accra.
A rate hike in the cost of borrowing from Ghana's central bank was expected. The country's economy had struggled to slow inflation throughout last year.
The MPC sees the need to remain vigilant and moderate liquidity in the system to underpin the macroeconomic adjustments taking place to drive inflation on a downward path. Under the circumstances, the committee decided to increase the policy rate by 100 basis points to 28%.
In December, inflation rose to more than 54% on an annual rate, the highest in the country's history. The local currency, cedi, has depreciated sharply against the US dollar in January. Analysts say the hike in interest rates will mean the cost of doing business will shoot up. Borrowing from banks will now be more expensive, and they worry the rate hike may not slow down inflation entirely.
Our structure is not supportive of any policy program that we are introducing. Okay, so yes, you're introducing a policy hike targeting inflation, but there are some other elements of the economy that will work against that.
Ghana's economy is import-driven, something that makes it difficult to control inflation and also reduce the pressure on the local currency. The government is eyeing a $3 billion loan from the IMF to help the economy recover. It reached a staff-level agreement with the IMF for the bailout in December and hopes to receive the first tranche of the loan in April. The government believes it will help bring down inflation and also strengthen the cedi. Nabil Ahmed Rufai, CGTN, Accra, Ghana.